The pattern that never fails. There is a pattern in history that has never failed, not once. Across 6 centuries, across empires, across continents, every global reserve currency has followed the same arc. Rise, dominance, arrogance, overextension, debasement, replacement. The Portuguese real dominated global trade for roughly 80 years in the 1500s. It financed voyages across oceans, underwrote the spice trade, and flowed through ports from Lisbon to Goa to Macau. Then it collapsed. The Dutch guilder ruled global finance for nearly 80 years in the 1600s. Amsterdam was the financial center of the world. The Dutch controlled trade routes, shipping lanes, and credit markets. Then it fell. The British pound sterling reigned for just over a century. From 1815 to the early 1900s, London controlled global trade. The Royal Navy ruled the seas. Sterling was the unit in which the world settled accounts. Then it died. Each currency believed it was different. Each empire believed its power was permanent. Each thought history did not apply to them. And each was wrong. The United States dollar became the world's reserve currency in 1944 at Bretton Woods. It is now 2026. That makes the dollar 82 years into its reign. The Portuguese real lasted about 80 years. The Dutch guilder about 80. The British pound just over 100. The dollar is no longer early in its cycle. It is late. This isn't prophecy. It isn't ideology. It isn't anti-American pessimism. It is mathematics. Every reserve currency follows a 7-stage life cycle. The stages are not random. They are structural. They are built into the incentives of power itself. First comes military dominance over trade routes. Then comes massive trade surplus and wealth accumulation. Then comes formal reserve status. Then comes permanent trade deficits. Then currency debasement. Then loss of confidence. And finally, replacement. The reason this pattern repeats is simple. Reserve currency status contains the seeds of its own destruction. To supply the world with your currency, you must run deficits. To run deficits, you must borrow. To borrow indefinitely, you must expand money supply. To expand money supply, you must dilute value. And once value is diluted long enough, confidence erodes. When confidence erodes, alternatives emerge. And when alternatives mature, transition begins. This is not about whether America is strong. It is not about whether the US military remains powerful. It is not about whether Silicon Valley innovates. It is about structural imbalances that no empire has ever permanently solved. In 2026, the dollar still dominates. It still accounts for roughly 58% of global reserves. Oil is still largely priced in dollars. Global trade is still settled primarily in dollars. But the cracks are visible. Trade deficits are permanent. Federal debt exceeds $38 trillion. Interest payments approach levels rivaling defense spending. The Federal Reserve's balance sheet remains historically elevated. Central banks are accumulating gold at the fastest pace in decades. BRICS nations are building alternative payment rails. None of this is collapse. It is stage progression. History never collapses overnight. It erodes slowly, then it accelerates. The Portuguese didn't wake up one morning to discover the real was dead. Merchants simply began preferring Spanish silver. The Dutch didn't experience a single dramatic moment. London simply became deeper, stronger, more trusted. The British didn't declare the end of sterling. The world just moved on. Reserve currencies do not die with explosions. They die with reallocation. And in 2026, the dollar is no longer climbing. It is defending. The next 9 segments will show you the 7 stages in detail, not as theory, but as documented sequence. And as we move through them, the question will stop being whether the pattern exists. The question will become, which stage are we actually in, and how far is left? Because if history holds, stage 6 is not a possibility, it is a probability, and stage 7 always follows. Stage 1, military control of trade routes. Before a currency becomes global, trusted, or safe, it becomes dominant. Not financially, but militarily. Every reserve currency in history began the same way. Not with economics, innovation, or banking, but with control of trade routes. Global commerce flows through choke points. Whoever controls them controls the currency of settlement. In the late 1400s, Portugal achieved something revolutionary. They mastered deep ocean navigation, crossing open water, while others stayed near coastlines. They rounded the Cape of Good Hope in 1488, unlocking a sea route to Asia that bypassed Ottoman-controlled land routes. But discovery wasn't enough. They militarized it. Portugal didn't just trade in the Indian Ocean, they dominated it. Armed caravels patrolled spice routes, fortified outposts were built at Goa, Malacca, Mozambique, Macau. Cannons faced outward from stone fortresses guarding trade access. If you wanted cloves from Indonesia, you dealt with Portugal. If you wanted silk from India, you paid in Portuguese real. Trade required their permission. The currency spread because the Navy enforced it. The Dutch followed the same formula in the 1600s. The Dutch East India Company, the VOCs, was not simply a corporation. It was a state-backed military enterprise. It had 40 warships, 20,000 soldiers, and full authority to wage war in Asia. They seized Portuguese trading posts. They controlled Baltic grain routes. They dominated Atlantic shipping. Amsterdam became the clearinghouse of the world because Dutch ships carried the world's goods. The guilder became the standard, not because it was morally superior, but because Dutch naval power made it unavoidable. Britain perfected this in the 1800s. The Royal Navy had more ships than the next 5 navies combined. They controlled Gibraltar and the Suez Canal. They controlled Singapore and the Strait of Malacca. Every major maritime choke point answered to London. If trade moved, it moved under British protection, and the pound sterling became the unit of global account. Then came the United States. After World War II, the U.S. didn't just win the war. It inherited the oceans. The U.S. Navy emerged as the dominant maritime force on Earth. Even in 2026, that remains true. 11 carrier strike groups, global bases positioned near Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. The infrastructure of global trade still depends on American naval protection. That is stage 1, and the dollar unquestionably achieved it. But here's the first crack in the pattern. Military dominance must be maintained. It is expensive, and it creates complacency. The Portuguese assumed their naval supremacy was permanent. The Dutch believed their fleet would always control Baltic trade. The British believed no navy could rival theirs. But maritime dominance always faces challenge. The moment another power builds comparable infrastructure, it weakens. The moment trade routes diversify, the moment choke points can be bypassed, stage 1 begins to weaken. In 2026, the U.S. still dominates the seas, but China now possesses the world's largest navy by vessel count. New shipping corridors are emerging through Arctic routes. BRICS nations are building alternative settlement systems outside Western-controlled trade networks. Military dominance still exists, but it is no longer uncontested. And when stage 1 becomes contested, stage 2 begins to strain. Because military dominance is only sustainable when paired with something even more important, a trade surplus. And that's where every empire begins to change. Stage 2, trade surplus and the accumulation of wealth. Military control opens the door, but trade surplus builds the empire. Every reserve currency nation, at its peak, produced more than it consumed. It exported goods, it accumulated wealth, it built productive capacity. Portugal in the 1500s didn't just control trade routes, it profited massively from them. Spices bought cheaply in Asia were sold in Europe at extraordinary markups. Lisbon became one of the wealthiest cities on earth. Gold and silver flowed inward. The Portuguese crown funded government operations, largely through trade revenues. The Dutch, in the 1600s, refined the model. Amsterdam became the warehouse of the world. Dutch merchants mastered arbitrage, buying low in one market, selling high in another. They exported ships, textiles, and financial services. Wealth accumulated not through consumption, but through production and trade discipline. Then, Britain. In the 1800s, Britain was the workshop of the world. It exported textiles, steel, machinery, rail systems. The trade surplus funded London's financial dominance. British manufacturing led the Industrial Revolution. The pound was trusted because Britain produced tangible value. Now consider the United States. From 1945 to 1970, America ran the largest sustained trade surplus in modern history. Europe was rebuilding. Asia was rebuilding. America exported everything: automobiles, steel, machinery, agricultural products. Fort Knox held over 20,000 tons of gold. The dollar became the reserve currency not only because of military power, but because America produced. This is stage 2 at full strength. Production exceeds consumption. Wealth accumulates. Currency strength is supported by real output. But here is where the pattern shifts. At some point, the reserve currency nation becomes so wealthy, so comfortable, that it transitions from exporter to importer. Manufacturing moves abroad. Finance expands. Consumption rises. Trade surplus turns into deficit. Portugal saw this in the mid-1500s. Gold from Brazil masked declining domestic production. Imports increased. Wealth was spent rather than reinvested. The Dutch in the 1700s shifted from trade to banking. They lived off accumulated capital instead of productive growth. Britain in the early 1900s began importing more than exporting. Investment income from overseas holdings financed deficits, temporarily. Now look at the United States in 2026. The U.S. has run continuous trade deficits since 1971, year after year. In 2026, the trade deficit still exceeds hundreds of billions annually. America imports electronics, machinery, textiles, pharmaceuticals. It exports financial assets. This is the structural reversal. When a reserve currency nation moves from exporting goods to exporting currency, stage 2 is over. And here's the mathematical constraint. To supply the world with dollars for reserves and trade settlement, the United States must run deficits. Dollars must flow outward. That means goods must flow inward. The Triffin dilemma, first articulated in 1960, makes this unavoidable. You cannot simultaneously maintain global reserve status and run balanced trade over the long term. One must give. History shows which one always does. The moment trade surpluses disappear permanently, the reserve currency enters its mature phase. It may still appear strong. Markets may still trust it. But the foundation has shifted. Production is no longer the engine. Finance becomes the engine. Consumption becomes the engine. Debt becomes the engine. And once debt becomes the engine, stage 3 formalizes the peak, which is precisely when decline quietly begins. Stage 3, formal reserve status, the peak that seeds decline. There is a moment in every reserve currency's life when dominance becomes formal, not assumed, not implied, declared. Treaties are signed, contracts are denominated, central banks codify the standard, and this moment, this peak, is when the seeds of decline are planted. Portugal experienced this in the early 1500s. The real wasn't just widely used. It was formally embedded in trade agreements stretching from Europe to Asia. Merchants accepted it without hesitation because Portugal controlled the routes and had the surplus to support it. But something subtle changed. Once the real became the unit of settlement, Portugal no longer needed to produce as aggressively. Foreign merchants needed the currency. So Lisbon began importing more, spending more, living on accumulated advantage. The Dutch saw this in the mid-1600s. The guilder became the currency of international contracts. Bills of exchange were written in Amsterdam. The Dutch banking system was the most trusted in Europe. Confidence was absolute, and absolute confidence creates complacency. Britain reached this moment at the Congress of Vienna in 1815. After defeating Napoleon, Britain stood unchallenged. The pound sterling was not just widely used, it was recognized as the anchor of the global financial system. Most countries operated under a gold standard that effectively meant a sterling standard. London became the center of global finance. This was the apex. And from that apex, the long arc of reversal began. Now the United States. In 1944, at Bretton Woods, 44 nations formally agreed to make the dollar the world's reserve currency. Other currencies pegged to the dollar pegged to gold at $35 an ounce. The IMF and World Bank were created to institutionalize this architecture. This was the most explicit formalization of reserve status in history. It was also the structural tipping point. Because here is the unavoidable truth. When your currency becomes the world's reserve, the world needs your money more than your goods. To supply that money, you must send it abroad. To send it abroad, you must run deficits, and deficits must be financed by debt. This is the Triffin dilemma in action. The very privilege of reserve status forces the nation into structural imbalance. From 1945 to 1970, the United States could maintain trade surpluses while supplying dollars. But by 1971, the system broke. Foreign governments were redeeming dollars for gold faster than America could maintain reserves. President Nixon ended gold convertibility. The dollar became purely fiat, and the deficit era began. In 2026, the dollar remains the formal reserve currency, but its backing is no longer gold. It is trust. Trust in U.S. Treasury markets, trust in Federal Reserve policy, trust in American institutional stability. Trust is powerful, but trust is fragile. Stage 3 is always the moment when the world believes the system is permanent. Portugal believed it, Amsterdam believed it, London believed it, Washington believed it. History says permanence is illusion, because once deficits become structural, stage 4 becomes permanent, and once stage 4 becomes permanent, stage 5 becomes inevitable. Stage 4, permanent deficits and living beyond means. This is the turning point, not the collapse, not the panic, the normalization of imbalance. Every reserve currency nation eventually crosses a line where deficits are no longer temporary. They become structural. At this stage, the nation stops exporting wealth and begins consuming it. Portugal in the mid-1500s began importing grain, textiles, and manufactured goods in increasing volumes. Gold from Brazil masked the imbalance. As long as bullion arrived, spending could continue. But the gold wasn't reinvested in productivity. It funded courts, palaces, military commitments. Consumption replaced production. The Dutch followed a similar arc in the 1700s. Amsterdam's merchant class became financiers rather than producers. They lent money to Britain and France. Returns flowed in, but domestic production stagnated. Trade surplus faded. Capital income replaced manufacturing. Britain entered stage 4 in the late 1800s and early 1900s. By 1900, Britain was importing more food and goods than it exported. The trade deficit was financed by returns on overseas investments accumulated during prior centuries. It worked, temporarily. But Britain was no longer the workshop of the world. America and Germany had surpassed it industrially. Now consider the United States in 2026. The trade deficit has been continuous since 1971, year after year. The U.S. imports consumer electronics, industrial components, machinery, pharmaceuticals, textiles. It exports treasury securities. The mechanism works like this. America sends dollars abroad. Foreign nations send goods. Foreign central banks recycle those dollars into U.S. government bonds. The cycle repeats. This is sustainable only while the dollar retains reserve status. And here's the psychological shift. Deficits stop feeling dangerous. They become normal. Policy debates revolve around how to stimulate growth, not how to eliminate imbalance. Debt rises. Interest payments grow. But because the world still demands dollars, borrowing appears effortless. Portugal believed Brazilian gold would always flow. The Dutch believed capital income would always compensate. Britain believed empire would always finance imports. In 2026, the United States assumes global dollar demand will always persist. But the mathematics are tightening. Federal debt exceeds $38 trillion. Interest payments now rival core budget categories. Trade deficits remain entrenched. Manufacturing share of GDP has fallen compared to mid-20th century peaks. This is stage 4. It does not feel catastrophic, it feels comfortable. Because living beyond means can continue for decades when you are the reserve currency. But every previous reserve currency reached a point where deficits compounded faster than confidence could compensate. And when confidence begins to weaken, stage 5 arrives. Debasement. Not always dramatic, not always obvious, but always decisive. Stage 5, currency debasement. This is where confidence begins to fracture, not collapse, but fracture. Deficits can no longer be financed through productivity or savings, so they are financed through currency expansion. Historically, this stage always begins quietly. Portugal in the mid-1500s began reducing the silver content of its coins. The real still circulated, trade functioned, but the intrinsic value declined. Merchants demanded more coins for the same goods. Inflation spread, confidence weakened. The Dutch followed in the 1700s. Wars against Britain and France strained finances. Borrowing costs rose. The solution was gradual monetary expansion. The guilder's stability began eroding. Britain's debasement came through world wars. World War I forced suspension of gold convertibility. The money supply surged, inflation followed. Britain attempted to return to gold in 1925 at an overvalued rate, triggering deflation and economic stress. World War II ended the gold link permanently. The pound devalued in 1949 and again in 1967. Each signaled weakening reserve credibility. Now examine the United States. The shift into stage 5 accelerated in 2008. Quantitative easing introduced monetary expansion at scale. Roughly $3.5 trillion was added to the Federal Reserve's balance sheet between 2008 and 2014. Then 2020 arrived. In response to COVID stimulus and economic shutdowns, approximately $7 trillion more entered the system in 2 years. This was not coin debasement, it was digital balance sheet expansion. But the economic effect is similar, increased currency supply. From 2020 to 2022, inflation surged to levels not seen in 4 decades. Asset prices inflated. Housing prices soared. Equities reached extreme valuations. The purchasing power of savings declined. The dollar's debasement exports globally. Because commodities are priced in dollars, when supply expands rapidly, inflation pressures spread internationally. Foreign central banks holding dollar reserves face erosion of real value. Global trust does not collapse immediately, it decays. Stage 5 is not hyperinflation. It is structural dilution. Debt becomes easier to service in nominal terms, but harder in real terms. Government deficits remain elevated. Political incentives discourage austerity. Monetary expansion becomes normalized as a policy tool. The Triffin dilemma intensifies. To supply global liquidity, the United States must run persistent deficits. Persistent deficits require either borrowing or monetary expansion. In 2026, federal debt exceeds $34 trillion. Interest expense alone approaches levels that rival defense spending. Financing costs are no longer trivial. When borrowing grows expensive, central bank intervention becomes tempting. This reinforces stage 5. History shows that once currency expansion becomes structural rather than cyclical, stage 6 approaches. Not immediately, but inevitably. Reserve currency status depends on trust. Trust depends on purchasing power stability. Stability erodes when supply expansion exceeds productive growth. Stage 5 is the warning phase, the fracture line. Confidence does not vanish overnight. It weakens gradually. Once global actors begin adjusting behavior, reallocating reserves, diversifying trade, accumulating alternatives, the system transitions forward. Stage 5 is not collapse, it is preparation for the next shift. The timeline towards stage 6 accelerates. Stage 6, loss of confidence and search for alternatives. Stage 6 does not begin with a headline. It begins with behavior, quiet reallocations, small percentage shifts, technical changes in settlement systems, incremental reserve adjustments. Historically, this is the stage where the world stops trusting permanence. When Portugal entered stage 6 in the late 1500s, there was no dramatic declaration that the real had failed. Merchants simply began demanding Spanish silver instead. Contracts slowly shifted denomination. Asian traders adjusted pricing terms. Confidence eroded transaction by transaction. By the time Spain absorbed Portugal in 1580, markets had already moved on. The Dutch guilder experienced the same erosion in the 1700s. Amsterdam remained wealthy. Its banks were still respected. But global merchants began preferring London's financial markets. British naval dominance and industrial output made the pound attractive. Central banks gradually shifted reserves. No announcement, no panic, just reallocation. Britain's decline after World War II followed the same path. In 1945, the pound still carried prestige, but Britain was heavily indebted. The U.S. held most global gold reserves. The Marshall Plan tied European reconstruction to dollars. In 1949, Britain devalued the pound by 30%. Confidence dropped sharply. Central banks accelerated reserve diversification. By the 1960s, the transition to the dollar was effectively complete. Now observe the present. The dollar's share of global foreign exchange reserves has declined from 72% in 2000 to near 58% in 2024, 2026. That is a significant structural shift representing trillions of dollars moving elsewhere. Is 58% still dominant? Yes. But reserve transitions begin slowly and accelerate later. China has reduced its treasury holdings significantly over the past decade. Russia divested nearly all U.S. treasuries following sanctions. Central banks globally are purchasing gold at the highest rate since the 1970s. According to World Gold Council data, annual central bank gold purchases have exceeded 1,000 tons in recent years. Why gold? Because gold is neutral. It carries no counterparty risk. It cannot be printed. It is not subject to sanctions. Meanwhile, bilateral trade agreements increasingly bypass the dollar. China settles more trade in yuan. India negotiates rupee-based settlements. Saudi Arabia has accepted non-dollar currencies for oil sales. The petrodollar system, foundational since the 1970s, is no longer exclusive. BRICS nations have discussed alternative payment systems. The Shanghai Cooperation Organization explores cross-border settlement infrastructure. Digital central bank currencies are under development globally. None of these individually dethrone the dollar, but collectively they signal preparation. Stage 6 is diversification, not rejection. The euro holds approximately 20% of global reserves. The yuan remains under 3% officially, constrained by capital controls. Gold's share has steadily risen. Even small nations increasingly conduct regional trade in local currencies. Another indicator of stage 6 is sanctions overreach. When the U.S. froze Russian central bank reserves in 2022, it demonstrated the power of dollar dominance, but also revealed the vulnerability of holding dollar assets. Neutral nations observe that reserves can become inaccessible under geopolitical tension. That realization changes behavior. Stage 6 accelerates when the reserve currency becomes a geopolitical tool rather than a neutral medium of exchange. Confidence is psychological, not mechanical. It rests on the belief that assets will maintain value and remain accessible. When confidence weakens, nations seek optionality, not necessarily replacement yet, but alternatives. Multipolarity emerges. Trade blocs form. Regional clearing systems expand. Financial infrastructure diversifies. The dollar remains dominant for now, but stage 6 is defined by erosion at the margin. Every percentage shift matters, every bilateral settlement agreement matters, every gold purchase matters. Because reserve currency status depends on collective belief, and belief is fragile. Historically, once stage 6 begins, stage 7 eventually follows. The transition may take a decade or two, it may accelerate under crisis conditions, but no reserve currency in history has reversed course once stage 6 becomes entrenched. The Portuguese did not recover reserve dominance. The Dutch did not reclaim financial primacy. The British did not restore the pound to global supremacy. Stage 6 is not collapse. It is the beginning of replacement. And in 2026, the dollar exhibits multiple indicators consistent with this historical phase. Not panic, not immediate downfall, but systematic repositioning, slow, measured, and increasingly visible to those watching closely. Confidence, once cracked, rarely fully repairs. It shifts elsewhere. Stage 7, replacement, restructuring, and the global reset. It does not begin with collapse. It begins with preference. Markets begin choosing something else. Historically, reserve currency replacement has never happened through formal vote. It happens through usage, through settlement flows, through liquidity migration. The Portuguese real was not officially dethroned. Merchants simply preferred Spanish silver because it was abundant, standardized, and trusted. The mines of Potosi flooded global trade. Silver backed by production outcompeted a debased real. The Dutch guilder did not disappear overnight. London's capital market simply grew deeper. Britain's industrial production expanded. Naval dominance shifted. Trade contracts began denominating in pounds. Gradually, the world preferred sterling. The British pound did not collapse in a single day. It eroded across decades of war debt, devaluation, and industrial decline. The United States emerged with intact infrastructure, massive gold reserves, and dominant production capacity. By the time Bretton Woods formalized dollar supremacy in 1944, the market had already decided. Replacement follows strength, always. The successor currency belongs to the nation or system that combines productive capacity. Trade surplus, financial depth, military security of trade routes, and institutional credibility. Today, no single nation cleanly meets all five. China possesses industrial dominance and trade surplus, but lacks full capital convertibility. The yuan remains tightly managed. Capital controls prevent free global movement. Without open capital markets, a currency cannot become fully trusted. The euro has financial scale, but lacks unified fiscal authority. The European Union is economically powerful, but politically fragmented. Sovereign debt crises exposed structural weakness. Without a single treasury backing it, the euro remains constrained. Gold is neutral and trusted, but it does not scale for modern transactional velocity. There is insufficient physical supply. Cryptocurrencies offer decentralization but lack sovereign backing and remain volatile. Governments are unlikely to relinquish monetary control. So what does Stage 7 look like in 2026? It likely begins as fragmentation, not a single successor, but multipolar currency blocks, regional settlement systems, bilateral trade clearing, digital central bank currencies operating within trade corridors. The dollar may remain dominant in the Americas, the euro in Europe, the yuan across Asia, gold used for interblock settlement. This transition would not be orderly, because the scale of dollar integration is unprecedented. Global dollar-denominated debt exceeds $70 trillion. Sovereign bonds, corporate bonds, derivatives, all priced in dollars. Energy markets settle in dollars. Commodity exchanges operate in dollars. When the reserve currency weakens significantly, debt stress amplifies. Emerging markets that borrowed in dollars face repayment strain. If their local currencies depreciate, corporations with dollar liabilities confront rising costs. Sovereign reserves lose purchasing power. Stage 7 historically includes crisis. Britain experienced currency runs and IMF intervention in the 1970s. Portugal faced fiscal breakdown. The Dutch lost financial primacy entirely. The US scenario would be larger in scale, because the dollar is global. If reserve diversification accelerates, treasury demand weakens. That forces higher interest rates to attract buyers. Higher rates strain federal debt servicing. Fiscal deficits expand. Money creation pressures reemerge. This becomes reflexive. Confidence weakens, yields rise, deficits worsen, printing increases, confidence weakens further. That is the mathematics, not ideology. Arithmetic. Stage 7 does not require collapse of the United States. It requires loss of monetary primacy. That is different. The U.S. could remain wealthy, innovative, and militarily strong while no longer issuing the dominant reserve currency. Britain, after 1945, remained an advanced nation. It simply was no longer the financial center of the world. Reserve replacement changes cost of capital, it changes borrowing power, it changes geopolitical leverage. Exorbitant privilege fades. The ability to run structural trade deficits without consequence disappears. Interest rates normalize to market demand. This transition can unfold over 10 to 20 years, or accelerate rapidly under crisis. Historically, the final shift often comes during stress. Confidence is stable until it isn't. And once confidence breaks at scale, reallocation happens quickly. Investors shift, central banks rebalance, trade contracts redenominate, liquidity migrates, replacement becomes visible. The critical insight is this. Stage 7 does not ask whether a nation is powerful. It asks whether its currency is trusted more than alternatives. Trust rests on discipline, fiscal balance, monetary restraint, productive strength. In 2026, the dollar still holds dominance, but the world is clearly preparing optionality. That preparation is itself Stage 6. If that preparation accelerates under economic stress, Stage 7 follows. History has never recorded a reserve currency reversing from Stage 6 back to permanent dominance. The real did not recover, the guilder did not reclaim primacy, the pound did not reassert control. Every reserve currency eventually ceded its role, not because it collapsed militarily, but because mathematics overwhelmed prestige. The question is not whether the dollar disappears. The question is whether the global system transitions gradually or violently, because reserve replacement reshapes capital flows, debt structures, and geopolitical leverage. It restructures the financial order, and restructurings are never painless. Stage 7 is not apocalypse, it is reordering. But for those unprepared, it feels like collapse. For those prepared, it is transition. History shows both outcomes depend on positioning, not panic. And in 2026, positioning has already begun. What this means for individuals, markets, and the decade ahead. Reserve currency transitions are often discussed at the level of empires, but their real impact is personal. They affect savings, pensions, mortgages, asset prices, and purchasing power. When Portugal's real declined in the late 1500s, merchants saw wealth evaporate. Import prices surged, credit tightened, and trade networks fractured. When the Dutch guilder lost primacy, Amsterdam's middle class suffered. Financial assets lost relevance, and capital migrated to London. When Britain's pound declined after World War II, it impoverished a generation. British citizens experienced repeated devaluations. Purchasing power eroded, and the empire shrank. Now consider 2026. The dollar remains dominant, but its purchasing power has weakened significantly. Inflation cycles since 2020 have permanently reset price levels higher. Even if inflation moderates, price increases rarely reverse. Currency debasement compounds silently. Most people measure wealth in nominal terms, but real wealth is measured in purchasing power. When a reserve currency weakens structurally, asset behavior changes. Government bonds become riskier, depending on continued foreign demand. If central banks diversify reserves, treasury yields must rise to attract buyers. Rising yields pressure equity valuations, real estate markets, and corporate financing. This is not theoretical. The U.S. national debt exceeds $34 trillion. Annual interest payments approach defense spending levels. Debt servicing becomes a fiscal constraint. Historically, reserve decline periods include persistent inflation volatility and higher structural interest rates. Also, currency depreciation against real assets and capital flow instability. But here's the nuance. Reserve currency decline does not mean immediate economic collapse. Britain remained wealthy after sterling lost dominance. The Netherlands remained advanced. Portugal did not vanish. What changed was leverage. Borrowing costs increased, financial influence diminished, and trade flexibility narrowed. For individuals, this environment favors real assets over purely financial claims. Historically, tangible assets preserve value better than cash during late-stage reserve cycles. Land, energy, infrastructure, productive businesses, and commodities. Gold acts as a neutral hedge when confidence in fiat systems weakens. Central banks' renewed accumulation signals institutional hedging behavior. But diversification does not mean panic. It means awareness. Stage 6 transitions are slow until stress accelerates them. The next decade may not be a single collapse event. It may be characterized by recurring volatility. Currency swings, debt ceiling crises, reserve allocation announcements, sanction disputes, and regional trade bloc developments. Each episode chips at confidence incrementally. A reserve transition often culminates in a stress event. For Britain, it was post-war debt exhaustion and devaluation. For Portugal, fiscal strain compounded by geopolitical loss. For the Dutch, war fatigue and British industrial dominance. For the United States, potential catalysts could include accelerated reserve diversification, debt monetization cycles, persistent structural deficits, and geopolitical fragmentation of trade systems. Also, loss of demand for treasury issuance. None are guaranteed. But the pattern shows that once stage 6 begins, the final phase eventually arrives. Here's what makes this cycle unique. The dollar underpins the entire global financial system. Over $70 trillion in global debt is dollar-denominated. Energy markets price in dollars. Commodity exchanges settle in dollars. If dollar primacy weakens, the adjustment would ripple globally. Emerging markets holding dollar reserves could face valuation losses. Corporations borrowing in dollars could face refinancing stress. Central banks could rebalance aggressively. This is why transitions at this scale are rarely smooth. They reshape capital markets, reprice risk, and change geopolitical power structures. But they do not happen overnight. Transitions often unfold over 10 to 20 years. In 2026, the dollar remains the primary reserve. But diversification is measurable. Reserve share declines are incremental but persistent. Gold accumulation is strategic. Trade settlement innovation is accelerating. These are structural indicators, not noise. For individuals, the key takeaway is not alarm. It is positioning. Avoid concentration risk. Understand that cash is a tool, not permanent wealth storage. Recognize that reserve privilege historically fades. When it fades, asset volatility rises. The Portuguese merchant who shifted from reals to Spanish silver preserved wealth. The Dutch banker who moved capital to London survived. The British investor who acquired dollar assets maintained purchasing power. Transitions reward adaptability. They punish rigidity. The coming decade may not look like past decades of dollar dominance. Interest rates may not revert to zero permanently. Deficits may not remain consequence-free. Confidence may not remain automatic. History shows reserve cycles follow mathematics, not sentiment. And mathematics does not bend to exceptionalism. The dollar remains powerful in 2026, but power is not permanence. Understanding that distinction separates those caught in transition from those prepared for it. Stage 9 is not about fear, it is about foresight. Because reserve transitions are not visible until they are obvious, and by then, repositioning becomes expensive. History rewards those who recognize patterns early, not those who assume this time is different. The final stage, replacement, reckoning, and what comes after. Every reserve currency collapse ends the same way. Not with a single headline, not with one dramatic announcement, but with a shift in behavior. At first, it's subtle. A central bank reduces dollar holdings by 2%. A trade agreement settles in local currencies. An oil contract prices in yuan instead of dollars. A bond auction clears with weaker foreign demand. Each move seems small, but taken together, they mark the final transition, stage 7. Replacement. Not necessarily by one currency, but by a new system. When the Portuguese real faded, it wasn't replaced by decree. It was replaced because merchants preferred Spanish silver. Confidence shifted, trade adjusted, power followed. When the Dutch guilder lost dominance, the pound didn't seize it overnight. It earned it through deeper capital markets and military supremacy. When sterling declined, the dollar rose not just because Britain weakened, but because America had the industrial capacity, gold reserves, and military strength to assume the role. Replacement always follows power, and power follows production, trade control, and financial stability. So what replaces the dollar? That remains unresolved in 2026. China has the trade surplus and industrial scale, but the yuan lacks full convertibility. Capital controls prevent it from functioning as a truly global reserve. Europe has a deep bond market, but the Eurozone lacks fiscal unity and political cohesion. Gold is rising in strategic importance. Central banks are accumulating it at the fastest pace in decades, but gold cannot easily scale to support $100 trillion in global transactions. Digital currencies offer speed and programmability, but sovereignty and trust remain barriers. The likely outcome is not a clean succession, it is fragmentation. A multipolar currency world, regional blocs using different standards, trade settlement becoming more bilateral, energy contracts diversifying, reserve holdings spreading across assets. That fragmentation increases volatility. It raises transaction costs. It reduces the efficiency that a single dominant reserve provides. But it also reduces dependency on any single nation's monetary policy. Here's what makes this transition more dangerous than previous ones. Over $70 trillion in bonds are dollar-denominated. Emerging markets borrow in dollars. Corporations issue dollar bonds. Banks hold dollar reserves. Commodities price in dollars. If demand for dollars weakens materially, yields rise. If yields rise structurally, debt servicing costs surge. If servicing costs surge, deficits widen. If deficits widen, money printing increases, and the cycle accelerates. That is how reserve decline becomes systemic stress. Not because the currency disappears, but because the cost of maintaining dominance becomes too high. Now here's the critical truth. Reserve transitions are rarely total annihilations. Britain did not become poor overnight. The Netherlands remained prosperous. Portugal remained a nation. What changed was influence. Borrowing became harder. Military projection weakened. Financial dominance faded. For the United States, a stage 7 transition would not mean collapse. It would mean adjustment, higher interest rates, lower external demand for treasuries, more discipline required in fiscal policy, reduced ability to export inflation, less room for financial experimentation without consequences. It would mean living within production capacity, rather than privilege. And privilege is the defining characteristic of reserve status, the ability to print currency and exchange it for real goods, the ability to run deficits without immediate punishment, the ability to borrow at artificially suppressed rates. When that privilege fades, the system recalibrates, and recalibrations are rarely comfortable. This is not fear-mongering. It is pattern recognition. 4 reserve currencies, 6 centuries, 7 stages. Each believed it was permanent. Each assumed superiority insulated it from history. Each learned otherwise. In 2026, the dollar remains the dominant reserve. But stage 5 indicators are present. Stage 6 diversification is measurable. Stage 7 remains ahead, but not implausible. The timeline is uncertain. The pattern is not. And the people who understand patterns position early. They diversify, they hold real assets, they watch capital flows, they study reserve allocation reports. They recognize that confidence is a fragile asset, because reserve currency status ultimately rests on trust. Trust in fiscal discipline, trust in military strength, trust in institutional stability, trust in long-term purchasing power. When trust erodes, markets adjust, slowly, then suddenly. The most important question is not, when will the dollar collapse? The better question is, what happens to global power when the dollar no longer sits alone? That answer will define the next generation of geopolitics, the next generation of markets, and the next generation of wealth. History does not repeat perfectly, but it rhymes consistently, and mathematics does not bend to nationalism. It does not bend to ideology. It does not bend to optimism. Deficits compound. Debt compounds. Confidence compounds. And when confidence reverses, it compounds too. Understanding this pattern is not about panic. It is about preparation. Because the greatest financial transitions in history were invisible until they were obvious. And by the time they were obvious, the wealth transfer had already occurred. If this expanded your perspective, if this helped you see reserve currency dynamics not as headlines, but as long-term structural cycles, then you're beginning to think like capital moves, like history moves. And if you want to continue tracking this pattern, stage by stage, signal by signal, as it unfolds in real time, make sure you like this video, subscribe to the channel, because we're not here for daily noise. We're here for structural shifts, for historical patterns, for the signals most people ignore until they can't. Reserve currencies don't die dramatically, they fade mathematically. And those who understand the math position accordingly. The pattern is in motion, the timeline is advancing. And whether we accept it or deny it, history is patient. The question is, will we be